Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Last week was holiday shortened. This week is a full one, full deck, all hands on board. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning.
Morning, guys. And plenty of cues to go over and big headlines over the three-day holiday, market holiday at least.
Yeah. Well, that's right. And the globe is still in a bit of a flux, but good to see Prime Minister Narendra Modi, those big bang announcements and much needed as well. I think we'll analyze the impact of it all through the day, but acknowledging there is some softness and let's do something about it. Absolutely. I think that's the positive message that goes out.
Absolutely. And I think, so there are three triggers in that sense, right, which I want to just sort of start with. One, of course, came during market hours. The other two are new. And the other two, of course, are from Friday. One disappointed, the other did not. So Prime Minister Modi's Diwali GST Dhamaka promise is number one. That was on the 15th of August. Trump-Putin signal, more talks ahead. I mean, actually, you could call it a disappointment. You could look at it saying, well, the photo op was great and maybe both agreed to further talks. The third, of course, was the rating upgrade, which came through during market hours. Around 2:30 or so is when that hit the screen. And markets actually just shrugged it off. No reaction at all. And we'll address all three because those are the three things which you need to sort of address. The big question really is, can the two outweigh the one sort of problematic external issue? The reason why the market here in India was very focused on the Trump-Putin meeting essentially was because of the tariffs here. If Russia-Ukraine gets resolved, or at least there is a visibility for that to get resolved, will the additional 25% tariffs, which are set to take effect in a few days from now, 27th of August, will that be resolved as well? That has not happened yet. Okay, let's just take it from the top, right? So Prime Minister Modi has promised next generation GST reforms. It is significant. We'll have to see what happens. We also have, by the way, dates. Three group of ministers meeting on the 20th and 21st of August to discuss GST rationalization. Maybe as we reported, only two slabs, 5% and 18% and 40% for some goods, etc. So basically, simplification is the need of the hour, and I think that is very, very well acknowledged. Remember when GST was announced, right? I mean, what was the idea? A low rate ensures compliance and leads to tax buoyancy. But it got complicated along the way over the last many years, although collections, etc., have been good. Now, if we can simplify it, bring most goods down to that 5% level, I think it's going to do a world of good. We will talk, of course, sector by sector in terms of what this is going to do. We don't have to wait very long, as I said. Wednesday, Thursday is the group of ministers meeting, and I think that should give us an indication of where this is headed. Now, the other one is the Trump-Putin meeting, which has ended with a promise of more talks ahead. By the way, tonight you have Trump hosting Ukrainian President Zelensky and some of the European leaders in the White House, and he's tweeting nonstop about it over the last 2 hours or so, how it's a great honor, great pleasure. Remember what happened when Zelensky was at the White House last time? I mean, J.D. Vance, the vice president of the U.S., essentially asked him, did you say thank you once? It was an extremely acerbic meeting back then, and it was a disaster, basically. So we'll see what happens tonight. Again, this is important from an India perspective because if there is some sort of a deal, a visibility to deal, if all three players are on the same side, which is US, Russia and Ukraine, I think, the government officials, everybody will be watching for that in terms of can we draw a straight line from that resolution to the tariff issue here in India. So I think it promises to be an interesting evening later today. The sovereign rating upgrade, right? That happened, as I said, during market hours. And this is the thing, if this was a normal market, I think that the sovereign upgrade happening after 15 plus years would have led to a 50 paisa rally on the rupee and a 1% move on the nifty. Neither happened. The market just shrugged it off. And that basically is nothing but sentiment, which is very, very poor. You can see that on a variety of sort of aspects. FI selling, which has continued. Year to date, by the way, $13.5 billion is what FIs have sold so far. It's been more than made up for from DII buying, which remains to be extremely strong. But the fact is, I mean, FII buying or selling incrementally at the margin does matter, as we've seen in previous past episodes as well. So that sort of brings me to tying the levels here. I think you perhaps are looking at a bit of an up move over the next couple of days leading up to the GOM, the group of ministers meeting to decide on GST, etc. It'll keep sentiments sort of up a little bit, hopeful at least. But will this really change the direction of the market in a big, durable way? I think that at this point is still questionable, largely because of the external situation with regards to tariffs and, of course, the FI stance, etc. So the levels are up on your screen. 24,700 is the first resistance. It's the recent high. I think we clear that straight up on the way up on the word go. 24,757 is the 20-day and 24,830 is the 40-day exponential moving average as far as the Nifty is concerned. On the downside, support 24,337. For the Nifty Bank, similarly, resistance is the high of 55,582. And then the 20-day moving average comes into view. I mean, all these are 1.5% away. 55,941 is the Bank Nifty for 20-day moving average. And the support comes in at 54,900. GIFT Nifty, I think, is indicating a 250 odd point up move. It'll come up on your screen and gives us a sense of the positive open. So, yeah, 244 points higher implied open on the GIFT Nifty. Surabhi.
Okay, and a lot of that cheer perhaps coming in from the Independence Day speech of the Prime Minister, where the GST announcement was, of course, the big one, but there were several others as well, and we'll just get to it. For the time being, Asian markets are trading largely higher. Barring the South Korean markets, most other markets in the region are tracking developments very carefully with respect to these big meetings that are lined up in Washington today between Zelensky, a lot of the European leaders who've been arriving. There were some reports indicating that even Mr. Keir Starmer of the UK, that he might be accompanying the EU delegation as well. So we'll wait and watch. In the meantime, just to talk about some of the macro numbers that we got from the US. And that's really important because these are numbers relating to how the consumer in the US is behaving. Because of this, yields had actually moved up slightly, 2-3 basis points on Friday. Now, the July retail sales number is looking pretty okay, 0.5% increase in terms of July retail sales. But the University of Michigan's Consumer Sentiment Index, that fell to 58.6. And the other important number is while CPI numbers in the US have been fine and there's been no sign of a big pickup in inflation, look at the PPI number. Producer price index rose almost 1% in July, whereas the estimate was just a 0.2% increase. Something to keep in note in terms of how inflation in the US is moving. Now coming to the other big issue in terms of our takeaway from all these geopolitical meetings that are happening. And there is some talk about whether there's a breakthrough, whether Ukraine doesn't join the NATO, but US will give it this Article 5 quote-unquote, benefit, which means that there will be a security arrangement and whether Russia will play ball with that. So a lot of that is happening, but the short point is right now we don't have any visibility of this 25% additional tariff being taken away from India. So from our perspective, unless something changes, come the 27th of August, we are staring at 50% tariff. Now, we hope that there's a breakthrough and something gives way. In the Independence Day speech, it became very clear India's stance. Once again, and Prime Minister Modi had said that earlier as well. But he reiterated that from the ramparts of the Red Fort, that India is not going to compromise on the interests of its farmers, livestock keepers, and fishermen. All of these segments are top priority. So that's India's stance, and that's not changing. We hope something changes on the other side. GST, of course, we'll watch out for the individual sectors and how the announcements will play out. 5, 18 and 40% are the categories. I'll also watch out for NTPC because the Prime Minister in that Independence Day speech spoke about nuclear power in a big way. Increasing production 10 times by 2047. So it's a clear focus area. And watch out for defense stocks. The Sudarshan Chakra was announced. And, generally that speak could lead to some kind of excitement coming back in some defense names as well. Finally, fund flows. And again, it's more of selling. That's what we had in the last trading session. Almost 2,000 crores of selling from FIIs, domestic institutions, offsetting that by almost 4,000 crores of buying. Nigel, over to you.
Well, the globe is in a bit of a flux, as I said earlier, but it's good to see both our RBI as well as the central government that's focused on growth. and they're acknowledging there is a bit of softness in the economy, and they're taking it head on. I think that's the positive message that is sent out. And though the globe is in a bit of a flux, the question is, has that 24,000 odd mark, is it going to be marked as a near-term bottom because of the triggers that we have? And for me, there are two big cues. One is the kind of liquidity that the domestic mutual fund industry is sitting at. It's close to around 2 lakh crore, which equates to around 6%. And that's, the highest we have seen in the last few months or thereabouts. So the domestic liquidity is there. They are sitting with those ammunition. They're ready to allocate money. That's a positive. Point number one. Point number two is with regard to the FI positioning. The FIs, well, they are net short. They continue to hold on to their net short position at the higher end of the band. We have seen around 2 lakh contracts in the past, but around 1.85 lakh contracts. Well, the FIs aggressively net short, and they haven't really shown any kind of signs of covering those shorts. If the markets can hold on or build on, they'll be forced to cover those shorts. And the short positioning is at around 92% or thereabouts. So the FIs are holding on to their shorts, but in the past week, there were mild signs because, after a while, after 6 weeks, the Nifty ended well in the green, and you had the open interest that was lower. And even on Thursday, that was the case that did play out. So for the market on the whole, there's a bit of a short covering that's taken place. Moving to the options data, two strikes come up for you on the screen. The 24,600 put, well, that was fairly active, premium at around 115 rupees. Now, this is the crucial one. The 24,700 call, there was a good amount of build-up, and there was writing that we saw at these levels. Now, going by what the GIFT Nifty is indicating, I'll be very disappointed, if the first hour high is not taken out, and then, in fact, we should end higher than what we start off with. That's going to be the important point, because the 20 DMA in all probability gets taken off to start off trade. But by the time we end up, you want this level to decisively get conquered, and you want the Nifty to make that move towards the 25,000 odd mark. Important. If you get past this, those shorts in the system will get a little bit iffy. And as we've been mentioning, this is the crucial support zone. If this breaks, then you're looking at around the 200 DMA, which comes in at around 24,000 or thereabouts. So that's the important mark. By the end of today, you'll want to end much higher than what the GIFT Nifty is suggesting as of now, which is the 200, 220 point gap up. The Nifty Bank, that's been the one that has been underperforming a little bit. But, in the last few days, it's showing signs that it wants to come back. Now, it's met with some crucial resistance at around this 56,200 odd mark. So that's going to be the important mark. The Nifty Bank needs to find its form. The bulls, they start off, strong, but they want to end strong in today's session.
All right, Nigel, thanks very much for that. Richard Yenska is Group Chief Economist at ANZ Research. Richard, good morning. Great to have you with us here on the program. Thanks for joining us. A lot on the table. The big one, of course, we'll see what happens on the GST, the local front, because the government is trying to, I guess, at some level, buffer the economy away from the impact of some of these trade shocks, etc., as well. And that's up ahead. But with regards to Russia, Ukraine, and an end to the conflict aside, after what has transpired over the last 72 hours or so, has the chance of that gone up, gone down? Or is the same, Richard? What's your sense?
I think, honestly, the markets are taking all of this as the news comes out. Obviously, there was a lot of speculation into the weekend about what might happen. I really don't think, though, markets are trying to be too forward-looking on these sorts of events these days. I think they're kind of more comfortable with the idea that they'll wait and see if something is delivered. This conflict's gone on for a few years now. The US administration attempted very early to try and reach a peace agreement very quickly, and that obviously didn't transpire. So there's a certain amount of Groundhog Day about this, and I think markets will just take the news and see where we are. On the GST, though, I would say it's important, I think, for India's long-term potential that these changes are done with a view to what the right structural tax system is, rather than trying to use the GST system to buffer against current shocks. Shocks, of course, come and go, but the tax system is much, much more difficult to change.
Yeah, Richard, that's a great point, and this is what we'll be, of course, debating with a lot of people throughout the day, because it's a big change that India is right now proposing, doing away with 2 tax categories entirely, bringing it down to just 2, and there will be some revenue loss. I think officials are already acknowledging that. They're hoping the buoyancy in the economy will make up for any loss in revenue. Your thoughts? Right way of looking at it? Right way to go?
I think thinking about that trade-off in India's case absolutely makes sense. If you can deliver some meaningful reform that frees up resources, then I think you can reduce the average rate of tax. I have a different view about how successful that might be in the US, but certainly in India's case, it's possible. And of course, most economies only have one GST or VAT rate. Few have 100% coverage, so most have some exemptions, but India's kind of four-level tax system, of course, has been a bit unusual. So bringing that back to two, which simplifies the system a lot, you could argue reduces half of the complexity in the system. I think that's a big step forward.
Hi, Richard. Good to see you, Ben. Well, we've got an upgrade as well out of nowhere, on Thursday itself. And that came after many, many years. What is your reading of the situation? Because some were doubting, the India story. And just take a look at this bounce back, rating upgrade. Your take on it?
Oh, it's positive, no doubt, but it doesn't change the strategic picture. The rating changes for the most part reflect what the fundamentals have already done, or at least the direction in which the fundamentals are tracking. And of course, rating changes at certain cusps matter much more. But I think in general, you might get a one-day move or a two-day move on your typical rating shift, and then that's probably about it. And I think that's appropriate this time. The questions about India are well known. Great performance over the last decade or so, great potential over the next couple of decades, but let's see what reform comes through to actually validate that potential.
Got that, Richard. The only thing is that we did not even get that one-day reaction. That's how negative the sentiment is. And by the way, the Nifty is the only market in Asia which is negative this month. Sentiment has been poor, especially because FIs have been selling. Thanks very much, Richard, for joining us. Good speaking with you, and good to get that perspective. We'll take a quick commercial break here. What are the interactions which are lined up here on the program? So 8:35, Sudhir Kapadia of EY joins us. GST in focus, 9:20, Gautam Dugar of Motilal Oswal Financial Services. I mean, that's the best voice to take us through sector by sector impact because of the GST cuts. Potential GST cuts. 9:30, IRB Infrastructure, short conversation on the first quarter performance. We have Vinati Organics joining us at 9:40 to talk about their earnings. Nikhil Gupta of CLSA will join us to talk about the sovereign rating upgrade, the GST reform ahead, and what that would do. So that's a voice you don't want to miss. Towards the end of the program, it's our special segment is the economy. Latha in conversation on the impact of the all the triggers on the local front, which perhaps are going to make a difference. So Neeraj Gambhir, Sonal Verma are going to be talking to Latha on that in a bit.
All right, time to slip into a short break. We've got a lot of stock-specific action to track for you on the other side. We'll get to that in just a bit. For the time being, I give you a sneak peek into the list. Tata Steel, JSW Steel, SAIL and JK Cement. All of them will be reacting to positive news flow, so I'm bringing you the good news this morning. On the flip side, you'll have textile stocks that will be reacting to negative news flow. You have chemical stocks, Inox Wind, Vodafone Idea and Glenmark that will be reacting to negative news flow, and expect a neutral reaction on the crude sensitives. Take that break, come back. We get into further detail on all of these names.
Welcome back. So the cues across Asia are fairly positive. Most markets are up and about, and the implied open is telling us today we are going to be in sync with the most of Asia, perhaps at the start. Let's get the implied open up. So we've got basically a 200-point bounce. That's what we'll begin with. Lots of stocks to focus on as well. So let's straight away get to the CNBC-TV18 list of top stocks to watch. So Nigel told us he's ringing in the good news this morning. Nigel, take it away. So first of all, some duty relief for steelmakers?
Well, that's right. It's good news coming in for Indian steel companies, because the DGTR, they have recommended the final safeguard on the steel imports for 3 years. So, in year one, they've recommended 12%, and it gradually decreases, 11.5% for year two and 11% for year three. Remember, as of now, you already had a safeguard duty of around 12%, but that was expiring in the coming month. That's in September 2025. So this is good news, positive, in line with expectations. It removes any kind of overhang, whether or not, this will be continued or not. They have that protection for the next 3 years. The street will like it. The next step that you're looking at is the finance ministry nod, but clearly this is a positive. In this sort of uncertain global scenario, you want some safeguard duty for the domestic players, and that's precisely what's happened. So continuity removes the overhang. Stocks open up in the green. Let's hop across to Vivek, though. He's tracking Inox Wind. Vivek, tell us more.
Well, good morning. A slightly muted quarter in terms of execution as far as Inox Wind is concerned. When you're talking about the numbers, optically quite strong on a year-on-year basis. Revenues higher by almost 29%, coming in at the 826 crore mark. EBITDA higher by 36.5%. Operating leverage playing out. When you're looking at the margins, higher by almost 100 basis points at 22.2%, and profitably aided by both higher other income as well as lower finance costs, has gone up multifold at 106 crore rupees. What's actually transpired is that the company has taken a deferred tax charge of close to 40 crore. And when you're talking about the Q1 execution as well as order book, that is where Street is slightly concerned. Execution is at 146 megawatt, order book of close to 3.1 gigawatt. Nuvama has written a note. They're saying that number one, they've cut the target price, also factoring in the rights issue. They're saying that the Q1 execution at 146 megawatt slightly missed consensus estimates of close to 180 megawatt, and along with that, they're saying that the order inflow was soft at 51 megawatt, so giving the company an order visibility or an execution visibility of around 24 months. I expect the stock to open slightly soft, but remember the stock has cooled off from recent highs.
All right, thanks very much for that, Vivek. Inox Wind in focus there. Vodafone Idea is the next one. Vinny's got details here. Vinny, morning.
Hi, good morning. So in terms of numbers that have come in from Vodafone Idea, largely in line, slightly below what in terms of profitability the analysts were expecting. Now in terms of net loss, that came in at 6,608 crores versus 7,166 crores, narrowing in terms of losses. But it's the 30th quarter that the company has reported a loss this time. And analysts were expecting much lower in terms of losses, but this number is slightly higher. Revenue, 0.1% growth there, so nothing, flattish on a sequential basis that we're seeing. Our margin seeing a contraction as well. Now ARPU, yes, it's seen a slight bit of a growth, 165 rupees versus 164 rupees last quarter, so slight improvement there. Total subscriber base, that continues to be at around 19.77 crores versus 19.82 crores. There's a reduction in terms of total subscribers. We are expecting the stock to open up in the red. The debt on the books has reduced, but with that, cash on the books also has seen a reduction versus last quarter. Key to watch out for in terms of commentary that will be coming in from the company in their con call today.
Okay, all right, Vinny, got it. Thanks very much for that. So we'll watch out for Vodafone Idea. Let's go across to Hormaz. Hormaz, because this number for us, US tariff is still 50% till we hear otherwise, right? Until some breakthrough happens in these talks.
Indeed, and it's a negative for all of these, be it the textile names, be it the chemical names, and these talks getting delayed also comes as a negative development as well. Now, what sources have told us that the 6th round, which was scheduled for the 25th, has been rescheduled, and the 25% additional tariff that was likely to be in place will take effect from the 27th, and with this, the effective tariff on Indian imports to the US will be now 50%, and as a result of which, look at these textile names, be it Gokaldas, be it Wellspun Living, be it Indocount, all of them have been beaten down names in the last 1 month. They get almost 50 to 70% of their top line from the US market. And also these chemical stocks, be it the likes of PI Industries, Naveen Fluorine, SRF, all of them have an exposure to the US markets. The shrimp feed manufacturers also, be it the likes of Avanti Feeds, Waterbase, and all of these stocks also, you keep an eye out on all of these names, expect a negative impact because of this news.
All right, thanks very much, Hormuz, for that. Glenmark Pharma, we're going to focus on. Ekta's here with details. Ekta, hi.
Well, yes, morning. Well, subdued set of numbers for Glenmark this time. The revenue was just about flat this quarter. We had the EBITDA, which came in at around, the margins came in at around 17.8% versus expectations of 18.7%. And the profit was below estimates as well. Overall, India was just about higher by around 4% year on year. North America was absolutely flat, but it picked up sequentially. Europe declined, but the company is expecting a pickup in the coming quarters. And the rest of the world markets was also flat. They do have their call at 8:30 a.m. More details then, but overall, based on this performance, it's subdued.
Okay, all right. Thanks a lot for that, Ekta. Well, I'm looking at JK Cement. And, for the cement industry on the whole, which currently gets taxed under GST of around 28%, if there is rationalization, it comes down to 18%. So that will be positive for volumes. Profitability could remain more or less intact, but cement becomes, more affordable. But the stock I'm looking at is JK Cement. It always enjoys peak multiples. The street believes that it's a high pedigree company, and they've been expanding as well as profitability intact. Now the stock, in fact, will be in focus today because they've announced expansion plan, and a big expansion plan. 4 million ton clinker unit and 3 million ton grinding unit. That's going to be in Rajasthan. And they've announced, grinding units, 2 million ton each in Rajasthan as well as Punjab. So effectively, the total capacity goes up by close to around 7 million tons. The capex they've announced is around 4,800 crores, and they're expecting this to be commissioned by September 2027. So the capacity will move up post this expansion to around 37 million tons, and it puts them on course to hit that 50 million tons that they have been talking about. Capacity expansion at favorable locations, as well as there'll be some incentives that they'll enjoy from the state governments as well. Going with green on this one. But moving to Manisha, she's here to tell us about the crude sensitives because they'll be in focus today. Manisha, morning.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices where we are extending declines yet again today after those two weeks of constant declines. So when you look at the month of August, we are down by 10% for the crude oil prices. For the year, the crude is down 13%. It's the 2-month lows that we are looking at on the screen there. Well, the US and Russia, while have failed to deliver a breakthrough on ceasefire, but a peace deal is what is being talked about. Russia has asked for Ukraine territories, and we haven't heard the end of it because the US president is meeting heads of Ukraine, France, Italy, European Commission, NATO, etc. today, and we will get to hear more from this one. The markets also are looking at the kind of increase in supplies that we are dealing with right now. Remember, the Chinese data has come in on the weaker side. The OPEC is increasing inventories, and the US production is near record highs as well. So supplies also continue to be on the higher side, which is continuing to weigh onto the crude oil prices. When you look at the fourth quarter, and most of the brokerages are telling you that it would be sub $60 a barrel that you could be looking at in terms of crude prices. So not too many people long right now. It still is for the creation of shorts that we are seeing in crude.
Okay, all right, Manisha, got it. Thank you very much for that. So crude sensitives on our radar as well. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow this morning would be JSW Steel, SAIL, JK Cement, Tata Steel, of course. There's also, of course, on the negative side, textile stocks, chemical stocks. These are largely because of the fact that there's no change on that additional 25% duty, which still continues on India, or 25% tariff. Inox Wind on the back of numbers, Vodafone Idea, Glenmark Pharma. Neutral view coming in on crude sensitives. Okay, we'll take a very quick break. Come back on the other side. We'll have Prakash Diwan joining in with some fundamental stock ideas. And Sudhir Kapadia of EY will talk to us about what we can expect on the mega GST reform.
Welcome back. Well, let's address some stocks. Prakash Diwan, market expert, joins us on the show. Hi, Prakash. Good morning. Good to see you in as always. Let's talk about first the fairest players, since that was those are the few stocks in our top 10 that are likely to react to positive news flow. Now, there was always a duty in place. Now you have some visibility for the next 3 years. There'll be protection between 11 to around 12%. So the overhang goes out of the way, and the street will appreciate that. What's your view on these fairest names, and what do you like? Because it's not only going to be the large cap names, even some of these mid-sized companies will react positively, and maybe some of those spike makers as well. They are second in the line, indirect beneficiaries. Your take?
No, absolutely. Good morning, Nigel. So I think this was kind of much awaited. It's been it's come through with some delay, and in the process, what's happened is most of the stocks have actually softened a bit. So it's kind of offering a very good entry point in most of the stocks, including the large caps. I mean, we've seen how the larger ones like JSW and Tata Steel have kind of lost some ground given the kind of the geopolitical uncertainties that persist. But what I feel is that if things start looking positively on the global trade with China, and generally China also kind of doesn't play a villain in terms of oversupply and things like that, there could be a very secular trend or a cycle that could be turning. And I would ride on that rather than just kind of some sort of a short-term tactical blip which could happen, which is positively, favorably likely to happen. But if that trend happens, there's the serious allocation that will come in from the active long-only funds as well. Because India's fairest capacity, given where ore is, given where demand is, I think is very well poised in terms of leveraging. The ROEs are going to become very, very significantly stronger. We've not seen that kind in almost like a decade. So I'm quite positive on it. I would bet a bit, and NMDC Steel, the numbers that came through, why did that surprise the market? Because nobody is anticipating quick turnarounds in some of these names. In fact, that I would go back to NMDC Steel and look at something like that even right now. After whatever has happened, because that's greenfield, it's likely to kind of start getting into a mature phase. and it could surprise us even further. It's not just one quarter, but things could look up even from a more long-term perspective.
Okay, Prakash, any individual stocks purely on the back of what has been announced can be done? A lot of possibilities, permutations, combination. Hopefully, they go all out with regards to this GST simplification. But are there any obvious winners here? Single stocks.
So, Prashant, very difficult to just restrict yourself to one stock, because if you really ask me, there's not just one beneficiary. It's going to be a whole, broad brush kind of a thing. But look at something like a Unilever. Why I'm talking about that is because atta, tel, sabun, as we keep calling it, these staples are where there was a lot of pressure. There's been volume growth, which has been very difficult to come by. Hygiene, personal hygiene and beauty products and all have kept things going, but it's not really working out in terms of this thing. So some of these names where it could have a broader impact in terms of changing the trajectory is where things could look up. People with good distribution, where the impact will be felt directly, will probably do much better than some of them. Some of the others, which will take some time to join the bandwagon. But I think from a perspective of valuation, risk reward as well, HUL stand a far better chance to kind of get re-rated than some of the other names, which are already kind of doing well and have been recognized.
Okay, Prakash, hi, morning. So on cars, I think we'll just put out that story that our colleague is putting out. I mean, that's the hope that from 28% cars move down to a lower slab rate as well eventually. You think that'll change fortunes? I mean, let's park M&M aside. We keep having that conversation. But I'm saying the rest of the sector, would you look at, let's say, a Hyundai or a Maruti any differently now?
A good one should be, no, definitely. I mean, see, this is the GST component in the purchase of new cars is significant in terms of what impact it makes. I mean, it's almost like saying you will have a discount which is across the board. You will have a discount. It's not, especially the taxation on the 4 meter plus kind of vehicles is so high that the car maker doesn't make great money. The dealership doesn't make too much money. It's usually a lot of taxes that make up for the large component. If this GST reduction happens and is passed on very clearly to the consumer, it's going to be, because see, demand elasticity from within the car segment is significantly high. I mean, you've seen price being so elastic that the moment you have reduction, whether it's a sale, whether it's festive season, whatever, things start looking up. Combine this with smaller EMIs. Combine this with a much better kind of convergence of utilization levels in terms of whether it's EV or hybrids and CNG and all of that. IC engine cars will not sell as much, but I think hybrids, EVs will continue to do very well if this price reduction kind of actually comes into effect. So you could get into a virtuous cycle on the auto segment as well.
All right, Prakash, stay with us. We're going to take a quick commercial break here. Sudhir Kapadia of EY joins us to focus on the GST news flow and what should we realistically expect. Someone who's seen and tracked tax developments over the last 3 decades. Stay with us.
Welcome back. Let's straight away get to the big story this morning. And can it really inspire confidence back in the bulls? The GST Diwali bonanza that Prime Minister Modi has promised from the ramparts of the Red Fort. Well, let's straight away get to an industry veteran who's been watching taxation for so many decades in this country. Sudhir Kapadia, Senior Advisor at EY, is with us. Mr. Kapadia, thank you so much for joining in. So it really feels like a bonanza, right? Because 4 rates, multiple structures, what is exempt, what is not. All of that, if, as you know, what our sources are also indicating, if it is all boiled down to simple slabs, 5%, 18%, and only very few sin items at 40%, does this look to you like the right way to go?
No, of course, it's the right way to go, Surbhi, for two reasons. One is that if you look at the GST equivalent around the world, Europe, if you look at the EU region, you look at Southeast Asian economies with which we should compare ourselves undoubtedly. The reason the tax has remained so sustainable in those jurisdictions is because of this very fact that they have very moderate rates consistently maintained, and most importantly, very little distinction between price points inter, say, products, very little distinction between varieties of, products under each category, etc. So I think the point here is that the rate has to be moderate, and 5% is by any yardstick very moderate, which I believe will cover probably more than 90% of items as far as at least the number of items is concerned, which is fantastic. The fact that 18% will now be probably and hopefully the higher rate for only certain goods, like, probably automobiles and something else, which is again very salutary considering the kind of rates they suffered today. And most importantly, and this is what government sources seem to be indicating, a point which I made earlier, that no artificial distinction based on price, right? That some item is more than price for so much and so much is less price, a rate is lower. And the composition, as I said, within that product. So I think if it is done in the way it has been announced, and I hope it is done in the way it has been announced, it is certainly salutary. And my last point I will make here is that it is also important that when a new issue comes up, the first impulse of the authorities is to raise multiple notices across the categories of assessees without first analyzing, whether this is really required, what is the clarity in law required. What happens is notices are first issued, then a thought is given based on representation. Good part is corrective action is taken, but a lot of effort and time and even money of taxpayers is wasted meanwhile. So when we talk of reforms, I am hoping all three will be covered, not just rate.
Absolutely, Mr. Kapadia. The one area where there is a lot of expectation, I think, because autos, right, I think is about 1/3 of the GST collections. So it's like perhaps the single largest item in that sense, right? Sources tell us that Centre has proposed a sharp reduction in GST rates on entry-level, two-wheelers, small cars, hybrid passenger vehicles, etc. So some detail here we want to bring to you. And then, Mr. Kapadia, coming to you. Timsy is here with those details. Timsy.
Well, that's right. What government sources are indicating to us is the fact that given that the Prime Minister from the ramparts of Red Fort did actually lay down that the government is working on second generation GST reforms, which could pave way for two slab structure, that is 5% and 18%. That is a standard and a merit rate, which could lower down the tax incidence on the common man substantially and is likely to take off from Diwali. Well, just a step forward there, sources indicate that Centre could have sent a proposal lowering GST rates on two-wheelers and small cars because Centre considers that these are no longer luxury and thus keeping them in the 28% slab or the highest slab could be wrong. The proposal under consideration is that two-wheelers with an engine capacity below 350cc could see a cut from 28% to 18%. Small cars below 1200cc engine capacity which is currently GST plus cess of about 29 to 31%, could be reduced to 18%. Similarly, hybrid passenger vehicles up to 4 meters length and 1200cc petrol and 1500cc diesel engines could be reduced from 28% to 18%. Whereas to end the classification matters, the other passenger vehicles, that is big cars, luxury cars and SUVs, etc., could be kept at the highest slab of 40%. Let's see what happens when GOM on rate rationalization actually deliberates on this matter, whether they agree with the Centre's proposal to reduce all the items to a two-rate structure or not, something that we'll have to wait and watch for. But yes, as of now, these are the key highlights of the proposal.
I got that. Timsy, thank you very much for that. Mr. Kapadia, two questions. One, what could be the size of, there will be a revenue loss, right? What are you, put it another way, what is the size of the giveaway in that sense that you were expecting, one? And second, Are there any sectors where you think it'll show up in a more aggressive way with regards to a demand response as opposed to others? Go on, sir.
Right. No, it's difficult to estimate till we know what is the final sort of design which gets implemented. But a very, very rough estimate suggests that it could be 80,000 crores of revenue impact. And let's assume that is the figure for the purpose of this discussion. My view is that this is really what the center faced even going back in 2017 when the states were reluctant to sign on. Let's go back in history, and the reason this government was able to successfully introduce GST is the calculated risk, if I may say, which the government took, which the then finance minister, Mr. Arun Jaitley, took by backstopping or guaranteeing a 14% CAGR increase in the new GST regime vis-a-vis the old indirect tax regime. And that was one of the conditions based on which the states signed up. So the point I am making is that there would be innovative solutions available even today with the center if there is this strong will as expressed by no less than the Prime Minister, and that too on the occasion of the Independence Day speech, to find these solutions. Coming back to and linking to the second point, Prashant, you made, I personally believe, like in the first case I mentioned, going back to 2017, if there is good tax buoyancy, which I don't see any reason why it shouldn't be, demand certainly should increase. Consumable income should, and don't forget the income tax benefits up to rupees 12 lakhs, which is already now in play from April. So combined with that, certainly overall revenues for the government should improve. That is the tax fiscal policy 101, that with moderate taxation, simplified taxation, tax base increases, collection should increase. So this backstop which the center needs to give hopefully will not be as high, because this calculation, when you look at it on a as standalone basis as of today, without any increase in demand, looks high. But when you assume the increase in demand, which is a fair assumption, that is where the tax buoyancy improves, and therefore the impact on the balance sheet of the government will not be as high, is my submission.
All right. Hi, Mr. Kapadia. Good to hear your thoughts. So tax buoyancy will make up for any kind of shortfall. That's the big call that's coming in. And as we've been mentioning, the center taking note of some softness in the economy, that's a positive with regard to intent itself. Just a quick question with regard to implementation. The fear is that various purchases will be pushed forward, because now you know that cut is coming in the next 2 months. So in the near term, there could be a bit of a pile-up. What's your take on that? Will that cause near-term softness?
Yeah, no, that's a good point. Well, in consumables, obviously, for obvious reasons, it won't matter. Consumables cannot wait that long. I think it's really the white goods and the automobiles where what you mentioned may play out. But I guess that happens in any kind of tax reform. And for example, even in today's scenario of bilateral tariffs, right, where there is an expectation of either lower or higher tariffs. We saw what happened in the US as well in terms of accelerated imports into the US. So I think some of it is inevitable. But the important point here that if a roadmap is clearly given as soon as possible, and I think the council meeting is September, we are told, the earlier the better. At least people can plan, and more importantly, the manufacturers, the companies can plan their productions and their dispatches accordingly. So yes, the roadmap earlier the better. Some of it is inevitable, and the more transparency and clarity emerges sooner than later, that would be better.
20th, 21st, the GOMs are meeting. Hopefully, we don't have to wait very long, and things are announced quicker. In a market parlance, Mr. Kapadia, it's like announcing, it's like saying that we're going to do a QIP and then leaving it without a, right? I mean, there is an overhang. But yeah, I mean, hopefully this is, of course, the government is cognizant of it. Points taken, very good conversation. Thank you very much, Mr. Kapadia, for joining us. Really appreciate it. All right, we'll take a quick commercial break here. Trades with Sudarshan and Mitesh. We have Sudeep Shah instead of Mitesh join us today with their specific trades. Stay with us. Okay, welcome back. We got what, 9 minutes to go for the pre-open session. GST rationalization impact on specific sectors, right? And autos is the really big one. You heard from Timsy, you heard from Mr. Sudhir Kapadia. Sud is now joining in with market implications. What is the street making of it? Where is this likely to show up the most in a bigger way? So over to you.
So it's a big day for automakers thanks to the announcement of GST rationalization made by PM Modi in his Independence Day speech on 15th of August. So now remember that most of the auto GST on autos are mostly 28% or above that. So first talking about two-wheelers, which companies would be the biggest beneficiaries? Two companies that will benefit the most are Hero MotoCorp and Eicher Motors. So why so? So now bikes with engine capacity up to 350cc or less than 350cc, on that GST rate may be reduced to 18% from 28%. So for Hero MotoCorp, 95% of their sales of domestic sales come in this category. For Eicher Motors, 86% of their total sales have the engine capacity of 350cc or less than that. So that's the reason these companies will benefit the most. Coming to four-wheelers, so there will be two categories of rates. First, below 1200cc engine cars, for that tax may be reduced to 18% from 28% plus cess. Also, it also has small cess of 1 to 3%. For hybrid passenger vehicles, for petrol up to 1200cc, rate may be reduced to 18%, and for diesel passenger vehicle, that is hybrid up to 1500cc, here also rate may be reduced to 18%. Biggest beneficiaries here, Maruti, Mahindra and Mahindra and Ashok Leyland. Why Mahindra and Mahindra? So Mahindra and Mahindra also has tractor segment for which GST rate currently is 12%. Now there is an expectation that rate may be reduced to 5% from 12%. That's the reason M&M will benefit. Now, MS is saying that in 2008, when government had announced excise cut, rate cut and sixth pay commission, it had led to 20% plus demand in autos for the next 2 years, that is 2009 and 2010. So similar kind of demand MS is expecting because of GST rationalization. In two-wheelers, it believes that Hero MotoCorp and Eicher Motors will benefit the most, and in passenger vehicles, Maruti and Mahindra will benefit the most. Nomura is saying tax cut by 10% will boost demand in the range of 15 to 20%, and if GST cut on ICE vehicles happens, it is likely to significantly impact EV adoption because price gap between EVs and ICE would increase sharply, and as per Nomura, Mahindra and Mahindra, Hero MotoCorp and Ashok Leyland will benefit the most from GST rationalization.
Okay, very, very interesting. Sudarshan, that Morgan Stanley note is interesting. They're talking about 20% increase last time around when this happened in the early 2000s. The only thing missing is a pay commission benefit that came in, that graphic. There was a pay commission impact as well, and now that's the only thing you can argue. The tax cuts have happened, income tax, maybe even GST, but whether there's enough pay power for people to go out there and consume. But anyway, let's focus on consumer durables as well. Upasana is here with what the proposed cuts could perhaps mean for this segment. Upasana.
Well, lower GST rates proposed by the government are expected to spur the demand for consumer durables, especially for the categories like ACs and large TVs. Now, currently, if we look at the current rates within electronics, ACs and large TV screens above 32 inches are at 28% GST slab, while other categories such as smartphones, refrigerators, small screen TVs below 32 inches, washing machine, microwave, geysers are at an 18% slab. Now, looking at the brokerages, Jefferies says that the GST rate rationalization is expected in Q4 CY25, and it sees a good chance that GST on ACs may come down to 18% versus currently 28%. CLSA says that the air conditioner currently attracts a 28% GST rate, which could potentially be lowered to 18%, and it expects this change to strongly influence demand for air conditioners, particularly after the recent signs of weakness that was seen in Q1 FY26. Now, to consumers, as durables as a sector, it believes that this change will affect both the demand growth and profitability of the sector. Kotak says that the new rates may provide 2.4 trillion boost, benefiting mostly autos and consumer durables. And lastly, according to the media reports, if we look at the company's comments on the back of this, Harry Appliances says that any rate rationalization will give significant boost to demand for AC prices, as prices are poised to grow up in the next year due to the energy rating. And also Blue Star has also commented and said that while AC will compete with many other categories, it's still a big positive for sales is what they are expecting.
Okay, all right. Thanks a lot for that, Upasna. Well, let's hop across to Vinny. She's focusing on apparel as well as footwear. Vinny, take it away.
Hi, good morning. So obviously this is something positive that comes in for both apparel as well as footwear companies. Now this will improve obviously affordability in terms of GST rationalization that comes in, affordability improvement as well as will spur consumption. Current GST rates that we would look at, now apparels that are priced below 1,000 rupees are currently in that 5% slab rate. That remains the same. Apparels that are priced above 1,000 rupees, they are currently taxed at 12% and that will come down to 5%. So that positive comes in over there. Footwear below 1,000, 12%, and likely that could change to 5%. So that will be where it will remain at, and that's the positive sign there. While footwear above retail price of 1,000 rupees is at 18%. So that is the benefit where we'll see coming in. Now for Trent, when you look at it, 1/3 of their sales actually come in from West Side, where most of the products are 1,000 rupees and above that. So yes, for Trent, the West side of the format will see us more benefit coming in. Zudio is currently priced below that 1,000 reach. That's a value side. That's 2/3 of their sales, so not a benefit on that front. But for West side format, Trent will see a benefit. Page Industries, around 40% of their sales, which is largely outerwear. That is where the prices are mostly above 1,000 rupees, and that's where we'll see that benefit coming in from moving from 12% to 5%. So 40% of their sales could see that benefit of this GST rationalization. But 40% of their sales are again priced below 1,000, 60% is priced above 1,000. So 60% of the sales will see the benefit coming in for rationalization as well. And for Metro Brands as well, 90% of the sales from footwear is above 1,000. So we could see that rationalization benefit that could come in here for footwear companies as well. Specifically, if they are in that range of 1,000 rupees, then from 5% to 12% to 5% is the benefit there.
All right. Thanks very much, Winnie, for that. So, yeah, I mean, footwear, apparel, autos, and then there are other sectors, right? I mean, cement, question mark, insurance, question mark. We'll see if some of this stuff really, yeah, sorry.
Cement, just a quick number, if you, the total collection, because of at 28% is roughly around 85,000 crores. So 10% pullback will be around 25 to around 30,000 crores of loss. For cement companies, the pricing will come down proportionately, obviously, but the volume push could come about. So the gain will be on the volume side, and the higher volumes will result in higher absolute EBITDA. Otherwise, on a per ton basis, not much is likely to change.
All right. Let's bring in Sudarshan Sukhani, who is with us, right, for a quick technical setup. Sudarshan, good morning. Good to have you with us here. Thanks very much. Got a 300-point bump on the GIFT Nifty indicative pre-open coming up in a minute. What would you recommend?
Yeah, good morning. Well, last week I had recommended buying a call and buying a put. For traders who have actually done this, your call options have become 2 or 3 times more, I hope, when the market opens. Take your profits. For those who want to trade today, the Nifty is likely to see a significant rally if this news or if the markets accept this news properly. So wait patiently, look for a sharp intraday dip and go long.
Yeah. In terms of specific trades, Sudarshan, what do you have?
Well, I have Hindalco. It's an all-buy list. I have Hindalco, which you can buy with a stop under 681. Hindustan Zinc from the same group. I mean the same sector. Buy with a stop under 417. And then Eternal. Buy with a stop under 311. Look at how the remarkable rally has been. Probably going to continue. And Mazagon Docks, which is a defense play, buy with a stop under 2664. It's spread all across because you want to buy the Nifty anyway. So focus on mid cap separately.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's talk about Hindustan Copper. That's a stock on our radar. They reported actually a good set of numbers in the first quarter. There was some growth. The margins as well came in at a healthy more than 40%. To help us out with what's the way ahead, we're joined by Mr. Sanjeev Kumar Singh, the Chairman and Managing Director at the company. Hi, Mr. Singh. Good morning and good to see you in. Thanks a lot for joining in. Congratulations on a good start to the year. Help us out. What was the volume growth in the first quarter, if you could help us out with that number? And also, if you could tell us, earlier we were talking about, I think, around 15% volume growth for the year. Is that on?
Yeah, that is there. That is on the track. That you can see from my results also. And these first quarter we have maintained as because of our operational efficiencies, and we have kept our expenses in control.
Okay, so what will the volume growth, sir, be for this year? What are you guiding for?
Our target this year is about 4 million tons of copper ore, and we are online with this.
Okay, all right. And in terms of MIC, what will it be?
MIC, it will be around 31,000 tons. We are aiming for that.
31,000. And that compares with last year, what would it be?
If you see, last year it was 24,000. So it will be a good growth, I should say.
Okay, all right. So you're guiding for 4 million tons of copper ore production. And in terms of MIC as well, it will be around 31,000 tons, which is a 20% growth nearly in comparison, more than 20% growth.
Roughly, it will be around 20%. It won't be exactly 31,000, but definitely it will be around 31,000.
35,000, sir?
No, 31,000.
31,000, got it. All right, just wanted to clear the air on that. But you're saying 20% volume growth. Yeah. Got that out of the way. What about your reserves, sir? The last time around you joined in, you were saying there is focus on increasing the reserves gradually because it gives you all then, a longer runway. What are the current reserves that you are sitting on?
The reserves stand on the same place. The focus still is on exploration and all that. The figures have not come yet.
Okay, but you could tell us what was the last accounted for number and what is the way, by the end of this year, what could it look like?
See, last year's figure were 755, but the figures of this current year have not been added to it. I mean to say 24, 25, still they are under finalization.
Okay, all right. What about copper prices, sir? How are the demand-supply dynamics working out? If you could help us out on that front, how are the demand-supply dynamics working out? And in terms of a band, what levels should we be working out?
See, the copper prices are quite stable, except this little bit volatility in the short-term period. The long-term fundamentals are very robust because you see there is a transition all across the globe for energy, electric vehicles, and you are also aware that in the last few months, say 2 quarters, the consumption, the largest consumer of copper has become AI. The data centers which are being constructed for AI are consuming huge amount of copper. So as far as this thing copper usage is concerned, it's very stable, and I hope that the market prices will remain quite stable in long term.
You want to give us a number, sir? Absolute number?
No, numbers cannot be given because there's a lot of volatility because of the global issues and all that. So it's very difficult to predict the numbers.
So it will hold around current levels is what you're telling us?
I hope so.
All right. In January 2025, the JSW Group, you all signed an MDO with them.
Yes.
I think it was a 20-year MDO and there's an extension clause as well out there.
Exactly.
From Hindustan Copper's perspective, how do you gain?
See, that mine is very shortly going to start. We have got the environment clearance also from the government of India. And very soon, within a month or so, we'll be signing the executive lease deed also with state government. And that all the pre-mining activities are in progress. And we should start the mining operations. That is the first mining operation is the dewatering of the mine within, say, 2 to 3 months.
Okay, all right. So basically, they are the MDO. And what does Hindustan Copper, I mean, how do you all stand to get? What is the contours of the deal basically between the two parties?
That MDO is on a revenue sharing basis. In fact, that is the first MDO mode which Metal Mine has taken on the revenue sharing basis.
And how much share do you get?
12.5%.
12.5%. Got it. All right. Final couple of numbers before we let you go, sir. What is the EBITDA margin we should work with? You're currently at more than 40%. That's something that you were looking forward to. And the capex spend for this year, what is it likely to be? FY 26, 27?
Our target for 25-26 capex is about 350 crores. And we are already on track and we hope to achieve that. And as far as EBITDA margin is concerned, we'll try to maintain that.
All right. Final question. You got one critical mining block as well, right? Could you tell us, there was one mineral block that was being talked about that would come to Hindustan Copper. Has that happened? Is there any clarity on that front? Because, critical minerals is something that the street is pondering about, and PSUs could stand to gain. Anything you have heard about on that front?
No, not at all. We haven't got any critical mineral block as of now.
Okay, all right. A pleasure talking to you, sir. Congratulations on a good start to the year. Good growth, volume growth of 20%, capex spend of 350 crores, and you're confident of holding on to that 40% plus margins. Wishing you all the best for the remainder of this year, and we'll chat soon.
All right, well, that's Hindustan Copper for you. Stocks up about 1% or so. Let's just actually take a pause.
Yeah, all right. Let's take a quick question with Prakash Thiban. Prakash, you heard that conversation of Hindustan Copper. The stock has been all over the place, mind you. 400 rupees stock became 200 rupees. Now it's at around 240 rupees. But the management is walking the talk. And this is the only core copper player here in India. So, if you could tell us more.
So, Nigel, when what we've been talking about is ferrous because of the DGTR anticipation of duties, but I think it's the non-ferrous that seems seriously so promising. And copper is likely to continue a very strong secular bull run globally as a commodity. I don't see any reason why Hindustan Copper cannot participate or leverage on that. Of course, there are issues related to execution which have always not allowed it premium valuation. But the management commentary seems very confident. The body language is very confident. And you don't have businesses which grow at 20% CAGR for a very long period of time. So this is one of those rare businesses. I'm happy you're getting it at lower valuations. It's a great entry point as well. Don't try to kind of bottom fish here because you may not get those levels, but keep adding, laddering up as it goes along. And it's an amazingly great asset that will deliver outperformance on the broader market. So I'm very positive on copper and on Hindustan Copper. I mean, you have to figure out how you want to play it from a entry point or from an FNO perspective. Now it's not even in FNO, so that's also, I guess, another overhang that's gone.
Got it. Just want to quickly get you some specific names, right, in the pre-open. How are they opening? If you can have these stocks up, right? Maruti, Tata Motors, Ashok Leyland in the pre-open in terms of how they are starting. So from the auto pack, 6% on Maruti. Look at that. Tata Motors will come up 2%. And there is Ashok Leyland, which will come up as well. Next, look at Mahindra and Mahindra maybe as well. So, Ashok Leyland is up 2.5%. Mahindra and Mahindra is up about 2.5% as well. So that's one clear kind of winner which is coming through. The consumer staple names, which is maybe just look at HUL, Britannia, and HUL is up about 2.5%. Britannia should come up. Maybe Varun Beverages as well. That is a name which has been mentioned. Varun Beverages is actually absolutely flat right now. Durables, right? Look at Voltas, Havells, names like Amber, and Voltas is up 5%. Havells should come up on your screen 3%. And Amber is up about 4.5%. These are all very large moves which are coming through. Look at hotels as another space. Again, all this differentiation, above a certain price point, GST is this and under it, GST is that. Hopefully, all of that kind of goes away, all that complication. Lemon Tree is up on your screen, 3% higher, Indian hotels, etc. And then look at insurers, right? I mean, Max Life, SBI Life, HDFC Life. Again, here, will we see something? The industry, by the way, this is the peculiar case where the industry itself has been asking for a slightly higher GST because of the inverted structure. And we'll explain that more as we kind of sort of go along. But this is what is happening. The footwear and apparel names also should come up. Metro Brands, if you can put that up. Bata, Campus Footwear, Relaxo. Bata is up 3%, 3.5% on Metro Brands. And there is Campus Activewear, which is up about 2% or so. Relaxo is up about 1.6, 1.7%. So that's basically a bunch of range of businesses and stocks which are settling higher, anything between 3% to 5%. Maruti, the last I checked, I think it was up about 5% or so. Prakash, I mentioned 10, 12, 15 names. Anything strikes out to you?
I think this is very much on anticipated lines, but remember, till the reduction happens and we start working on the calculation, it's going to be a bit premature. This is just excitement, markets receiving it well and responding. But I would recommend or look at buying into anything today for sure. But as I said, HUL is probably one name which is due for a re-rating of sorts, and this is a good enough trigger.
Okay. All right. We'll leave it on that note, Prakash. Thanks very much for joining in. But for what it's worth, it's putting a nice little bounce on the Nifty, 300 points up in the pre-open. Let's see if we can get this kind of a pop at the start. Good time to go back to Sudarshan as well for a 9-10 idea. Sudarshan, which stock will you go with?
I would go with Eternal. Consider buying Eternal with a stop under 311.
Okay, Eternal is the call. On the Nifty, of course, a lot of the auto stocks are taking it higher, but actually overall everything. I mean, there's from the consumer space, Trent, Nestle, there's Lever. Auto, of course, is right off the pack. Even two-wheeler names like Bajaj Auto, for instance, up and about. Eicher, everything's up and about. The bank Nifty, by the way, is absolutely in step with the Nifty. So the bank engine seems to be firing as well. 1% gain for the bank Nifty at this point in time. But let's revisit the good news that we are getting in from some of the metal names, particularly ferrous stocks. Nigel, the good duty news coming in?
Well, that's right. There was a safeguard duty in place of around 12% that was effective, for the last 5 months or so. It was going to expire in the next month. But now the DJTR has come out with their recommendations. They're saying there's going to be protection for the next 3 years. So the street will be happy about that. They're saying in year one, it'll be 12%, then it'll gradually decrease to around 11.5%, and then around 11%. So, the short point is that, in fact, there was some uncertainty whether or not that would be extended. What would the percentage be in terms of protection? Now, that's come about, so the uncertainty goes out of the way, and the overhang goes out of the way in this sort of uncertain global scenario. So that's why the domestic names will be well protected. The next step is going to be the finance ministry. Now, it's a good news coming in for these ferrous players. Remember, they've come off considerably from the recent peak. So positive for them. And maybe you'll have an indirect benefit as well on some of these spike makers, the likes of APL Apollo, maybe JTL. They could gain. Even NMDC will see some kind of bottoming out there. So positive read-through for the sector. Next up, I'm looking at cement. And for cement companies, first of all, the GST rationalization could be a potential beneficiary for them as well, because as of now, GST rate is around 28%. It could come down to around 18%, which would effectively mean the government loses on taxes of approximately 25,000 crores or thereabouts. But particularly on JK Cement, there's positive news coming through on the weekend. They've gone ahead, they've announced a big capex spend. They're talking about putting up 4 million tons of clinker and around 7 million tons of grinding facility. The integrated facility with a high amount of clinker will be in Jaisalmer, Rajasthan, and the grinding facilities will be in Rajasthan as well as Punjab. The total capex that they've earmarked is around 4,100 crores. It's expected to be commissioned by September 2027. A rough math suggests that they're going to be doing this capex at around $80 per ton, which is encouraging because replacement cost is more than $100 per ton. So this facility comes on stream by September 2027. It pushes the capacity to around 37 million tons, and then they have their sights set on 50 million tons, which will be closer to them. So that's why positive news for coming in for JK Cement.
Right, lots on the radar, right? I mean, a bunch of news flow, but it's mostly all related to GST. And, can you take a durable view straight away on the back of what has been announced? Maybe, if you already liked something, this perhaps adds to the reason for especially sectors like auto, etc. Maybe it has been in a down cycle, especially the entry-level segment. SUVs is a different story. But if you believe, as some do, that the cycle is about to turn maybe in the last quarter of this year, does this, announcement, promise of announcements, etc., prepone that early demand arrival? So we'll see. But for now, 300 points in the Nifty. The sensex is up about 700 points. We're just counting down. A couple of seconds to go for the market open. We'll look at the first rates and go straight to individual stocks. And what do we have? First up, coming up on our screens, we got about 1.1%, 1.2% of the Nifty, 24,900. So the 1% of the Nifty Bank as well, 55,900 odd on the Nifty Bank. The small cap index is up 1%. The mid cap index will come up on your screen. That's about 1% higher as well. This 1% should have showed up on, by 3 o'clock on Friday after the sovereign upgrade. But there was absolutely a whimper of a response, nothing at all. But it's showing up this morning after some of this good news has accumulated. Heat map on your screen. I think all of it except two names are in the red right at the start. And autos is the big one. Hero, Maruti, Bajaj. And, of course, a bunch of other stocks out there as well. 300 points in the Nifty. Surabhi.
Absolutely brilliant looking screen. Look at that. It's all green, barring two stocks on the negative side, and big gains. Hero Moto 8%, Maruti 6%, Bajaj Auto 4%. And then come in the consumer names, because remember, most of the everyday essential items, that's what sources have been indicating, they'll move to a 5% rate slab. So Nestle, Lever, you've got Trent, about 2.7% up over there as well. Tata Consumer, almost 3% higher. And if there's so much of consumption happening, then perhaps it rubs off on lenders as well. So look at Bajaj Finance, look at actually everything in financials is up and about. Shriram Finance, 2.5% up. ICICI Bank itself, Kotak Mahindra Bank, 1% higher. Reliance is contributing 1% gain coming in there as well. SBI, 0.7% higher. So everything is up and about. Hardly any stock on the negative side. Relatively speaking, IT is obviously the weaker of the lot this morning. TCS Wipro flashing a little bit of red, HCL Tech slight red, and L&T is very, very flat. But otherwise, sort of glorious start to the week.
Well, it's a bazooka move actually to kickstart trade. And as I highlighted earlier, there are two big positives out there. The domestic mutual fund industry is sitting on ample liquidity, and the FIs are aggressively net short. So this sort of a gap up, if it sustains, it's going to force those shorts to cover out. Good start to trade, and the Nifty Bank as well moving to that 20 DMA. So the Nifty's already crossed the 20 DMA, the Nifty Bank moving towards that mark. You know, if we're talking about autos, take a look at consumer electronic companies. Voltas, I think it's circuit up 10%. It's locked the last time I checked. Just pull up that name. Blue Star's the other one that's up close to around 8%. So big move is what we're seeing on these names. And PG Electro Plus, remember they went ahead, they cut their guidance. The street was very, very skeptical. There are a lot of shorts in the system. That one's opened up with a gain of around 8%. So that EMS player as well is participating on the upside. From the FMCG names, Dabur, that's the stock that's up more than 5%, and volumes are very, very high on that name. So big up move is what we're seeing, still holding with a gain of around 5%. Zaggle reacting to its numbers. Positive reaction out there. Stock flying away up more than 6% as we speak. Niva Bupa, that's a stock from the insurance space that's holding with solid gains. So good move out there. And Ola Electric, they launched a new motorbike over the weekend, and it looked quite good. We'll have to see how performance shapes up on that one. But first look at it was pretty good. So that stock, in fact, is up and about in today's trading session. Volume's quite high. It's more than 100 rupees away from the highs that we have seen post-listing. But that one's, in fact, higher. Just one stock on the downside. I think Kaveri Seeds came out with a set of numbers, and that stock is losing out. It's down close to around 6% as we see.
Right, 300 points on the Nifty, 24,945 is where we are at. It's all GST. I mean, the promise of GST rationalization showing up in a big way. And of course, autos is the big winner. Maruti 6%, Hero 8%, Bajaj 4.5%, TVS 5%, Ashok Leyland 4.5%. So Hyundai is up about 4.5%. So kind of rising tide lifting all boats, right? But there is... the AC names, Amber, Voltas, PG Electroplast, 5 to 8% gains here. 5 to 9% actually. Voltas is up 8.5%, 9% now. So that's the other one. Havells, you can throw in the lot. Durables, right? Havells is up about 4.5% as well. Dalmia Bharat is coming up with a 4.5% pop. In the durables, AC Pack 6.5% on Blue Star as well. So yeah, I mean, it's... pure staples, which is, the lever, and except Dabur, I can't really spot very much else, which is up in a big way. Maybe there are one or two, but Dabur is clearly, which is up about 5% right now. From the pure staples sort of side of things at this stage. 2,000 stocks are higher, and we've got about only 400 stocks which are lower at this point. 40% on Sin Goods, right? Godfrey Phillips is down 4%. It's the largest volume-led loser on the NSE right now. Volumes are not very large, but 9,800, 36,000 shares on Godfrey Phillips at this point coming through. I mean, for a player like ITC, it kind of balances out because, they got such a large non-cigarette portfolio. So I guess there is that which is happening. So it's that kind of unchanged ITC at this point in time. So more coming up a little later. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Good morning. Do you think it's these GST cuts, bulk of things moving to 5 from 18 to 12? It'll provide that much needed durable lift to consumption, Ashwini? And which segments do you think are likely to benefit the most, in your opinion? The mass level, or still it's going to be the premium end?
So Prashant, just last week somebody was asking me, I don't know who it was, I can't recall, as to what would you wish for in terms of reforms, and I was saying that it's about time that the GST system is simplified. Number of slabs brought down to 2, which was promised at the time of the rollout of GST. And to my mind, this is a very welcome move. So I think all categories will be impacted, more so on the staple side, where the consumer is a little more price sensitive, and low-end autos as compared to the premium side, because the premium demand is not really that price sensitive. Having said this, I think the biggest benefit from this is going to be fewer controversies, fewer disputes with the department in terms of what tax is owed to the government. Hopefully, the simplification of the slabs will remove, that ridiculous example of popcorn, whether it is salted or caramelized or buttered, being charged at different GST rates. So I think that simplification adds to the ease of doing business, and that to me is a very, very big positive, in addition to probably stoking demand at the lower end of the price curve.
Ashwini, hi, morning.
Morning.
Yeah, indeed, that was quite the GST meeting. Infamous for the caramel versus salted popcorn, right?
That's right.
But yeah, this is far more meaningful, what we're hearing, what we're understanding right now. So from a market perspective, how do you play it? Do you go into staple stocks? Do you look at buying beaten down four-wheeler names? No one's been buying stocks like Maruti and Hyundai for a while, right? So how do you as an investor navigate for this new GST regime?
So, interesting question. I'm still trying to get my head around it. Autos has obviously been appreciated as a sector for a while. There have been no takers for it. And this might provide a rally for auto stocks in the near term. Medium term, we have to see if the demand revives. Now, zooming out, if I look at it, there are 3 or 4 factors at play. Number one is that liquidity and interest rates are far more benign now as compared to a year ago. Your inflation statistics are still telling us that there is no worry on the inflation front. You have a serious reform which promises to lift consumption. And hopefully, you have that additional 25% tariff on India going away at some point. Maybe not right away, maybe 3 months from now, 6 months from now, I can't say. Unless, of course, the US administration has singled India out for some punishment, which is possible. But I think, given how things are going, it's I would say that at some point in time, that additional 25% tariff is going to go away. So if you take all those 3 things into account and take the correction that's already behind us and look for a demand recovery 6 months down the line, that's overall positive for any consumption-driven stocks, whether it's auto, whether it's staples, whether it's domestic white goods, cyclicals, etc., etc. So I think overall the factors that are lining up for a more positive second half of this fiscal year are more than the headwinds, and that would appear to me to be the case as of now.
Hi, Ashwini.
Yeah, sorry.
Go ahead, please.
Yeah, and how am I looking to play it? I think, financials is still the best because, if demand picks up, then you should see an improvement in loan growth. You should see improvement in deposits growth, because deposits growth and loan growth are interlinked in a sense. And spreads are stable, funding is adequate, and hopefully no new loan losses will arise, and the stress on the microfinance sector will decline. So that may be an area that will continue to do well. At least that's what it appears to me. Yes, Nigel.
All right, Ashwini, hi, good to see you win. First, tell me what's on your wish list again, because it appears your wish lists get ticked off, so that's good. And, within the financials, what do you like? Some of these large private sector banks that actually underperformed, case in point being an HDFC bank, they actually outperformed in the last few months or so after underperforming for the last few years. What is your preference out there, private versus public banks, and also in the NBFCs, what do you like? Gold companies, suddenly, you had a blowout quarter coming in from Muthoot. Do you like that? Do you like the housing finance? What would be on your pecking list?
NBFCs as a starting point. I'm a value investor, remember, and so that tells me that NBFCs are undervalued at this point in time. Probably a lot of the stress is already priced in. If the second half promises to be better on credit costs, then I think in some cases you could see valuations move up from being at below book to maybe 1.2, 1.4 times price to book. That would still be a far cry from the 3+ time price to book that many of these NBFCs enjoyed as early as a year and a half ago. So that would be the first area of preference for me, especially the beaten down names. And the second would be, I would guess, the PSU banks, because, if you look through the results of the PSU banks, they've shown that they've proven to be nimble. I mean, the largest of them being the nimblest of them. And valuations are, again, very reasonable. If there is a broad-based growth, then I have no doubt in my mind that the PSUs will participate in that growth. And going back to a principle I always like, that when growth is abundant, valuations come into focus, and when growth is scarce, then quality growth come into focus. So if we build a case that growth is going to be reasonable pretty much across the board second half of this year with credit costs under check, then I think valuations be the focus, and that's why PSU banks over private sector would be my argument.
Got it. Ashwini, just a thought experiment. If these rates, auto rates come down, right? Do you think an entry-level car gets more of a boost or an SUV? Prices go down for both.
So it's a question of, where the consumer has moved to. The market globally has moved to SUVs. So it's not just India. Globally, SUVs is the preferred vehicle. And therefore, if the affordability on an EMI basis increases, it increases across the board. And that preference for SUVs is not going to decline. Having said this, there might be some first-time buyers who might find that accessing their first car becomes a little more affordable with lower rates and with GST cuts, and that might egg them on. We still have to see the GST cuts come through and when they become effective. So that's just a note of caution. I mean, we are all getting very excited, but there is still a lot of fine detail that's to become available.
I just hope there is no slip between the cup and the lip in that sense, right? That's always a thing. By the way, Maruti hit almost 14,000 rupees. It's come off about 250, 300 rupees from the highs. Actually, across the board, and that's to be expected. There is a little bit of a pullback, not very much. Still strong gains through and through.
Yeah, absolutely. By the way, one more category which is being widely discussed and debated is hotels where the average room rate is below 7,500 rupees. And there the hope and expectation is that the GST rate will move down to just 5%, as nominal as that. And that explains in parts why not so much Indian hotels, but a Lemon Tree, for instance. Yes, that's the stock, 5% higher this morning. So, big moves coming in over there as well. Just very quickly, this space, Ashwini, anyway, hospitality has been doing so well, right? Decent gains, good wealth creation over the last 1-2 years. Do you like anything here? And would you play, again, some of the more mass category offerings out there, or largely on the luxury side of it?
I actually like, airline stocks here, because I think on a sustainable basis, I thought that, Air India would set the cat among the pigeons, the takeover by the Tatas, but that unfortunately, for a variety of reasons, hasn't happened. The market continues to exhibit significant pricing power. So that's one. And even in the hotels industry, while a lot of capacity is coming on, the capacity addition lags demand. And my sense is that these two will continue to benefit from the domestic demand and shift in consumption patterns that we've seen. Obviously, if the GST rate for hotels below 7,000 rupees go down to 5% and above 7,000 go to 40%, you would expect some consumers to shift. I mean, the price differences would become very stark. And I imagine that in some cases, some of the kind of premium properties might need to look at their rates to reduce the gap in pricing. So at the margin, I think, yes, this is not so great news for premium 5-star properties, and stocks might take a bit of a knock. Again, Surabhi, I'm not prepared to pull the to make a call on this right away, because we don't know what the fine print will finally say on GST.
Okay, all right. Ashwini, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for taking out the time. Have a good week. The markets, of course, holding with anything between 4 and 7-8% kind of gains across a whole range of auto names, AC names, and to a lesser degree, some pure consumer staple names as well. But that was to be expected. There are these, I spotted Dalmia Bharat earlier, but there is Shree Cements, which has also come up now, 4% gain. So cement is also, one or two additional names that are showing up with regards to the moves that we have. Auto and consumer durable stocks are surging. And let's just revisit the thesis which the street seems to be making. Let's talk about auto first. So over to you.
These auto companies have suddenly come out of the city traffic and moved to expressways, and they are moving in the highest gear. So first, talking about two-wheeler stocks, why they are higher. So all the auto names currently are in the two tax bracket. First is 28%, or second, it's higher than 28%. So for the two-wheelers having the engine capacity up to 350cc or equal to 350cc, for them, tax, that is GST tax rate, can be reduced to 18% from the current rate of 28%. And two of the biggest beneficiaries of those can be first Hero MotoCorp, for which 95% of total domestic sales are in this bracket, that is 28 to 31%. Second, the biggest beneficiary can be Eicher Motors. Many people believe that they have most of the vehicles which have higher than 350cc, but that is wrong. So 86% of their bikes have the engine capacity up to 350cc or less than 350cc. Even Bajaj Auto and TVS Motor will benefit. For Bajaj Auto, 52% of the domestic sales are in this category, and for TVS, almost 70% of the total sales of domestic sales are in this category of 28 to 31%. As far as four-wheelers are concerned, two of the biggest beneficiaries in the passenger vehicle space are Maruti and Mahindra and Mahindra. Mahindra and Mahindra will also benefit from its tractor segment. For tractor, current GST rate stands at 12%, and there is an expectation that GST tax rate may be reduced to 5%. Amongst commercial vehicles, Ashok Leyland can benefit the most, because almost 90% of their vehicles are in this tax bracket of 28 to 31%. There also tax can be reduced. Why Maruti can benefit the most? Because they have so many vehicles below 1200cc, for which tax can reduce to 18% from 28%, plus cess that they have in the range of 1 to 3%. They also have hybrid vehicles in the petrol. So for petrol hybrid vehicles up to 1200cc, for that also tax can be reduced to 18%. Even hybrid with diesel vehicles having 1500cc, for there also tax can be reduced to 18%. What do brokerages believe? MS says they have taken an example of 2008, when government had announced excise cut, rate cut and sixth pay commission that had led to 20% plus demand for autos in the next 2 years, that is in 2009 and 10. They believe that GST rationalization can have a similar move. In two-wheelers, they believe that Hero and Eicher can gain the most, and in passenger vehicles, Maruti and M&M can benefit the most. Nomura believes that tax cut by 10% can improve the demand in the range of 15 to 20%, but this tax cut can be negative for electric vehicles, because price gap between electric vehicles and ICE vehicles will increase further. That can be negative for electric vehicles. For Nomura, M&M, Hero MotoCorp, Ashok Leyland are expected to benefit the most from this GST rationalization that Prime Minister Modi has announced in his Independence Day speech.
Okay, all right. So it got that, and the stocks are really showing that excitement and that hope that those lower tax rates will indeed come through. Thank you for that. Let's head to Upasna. She's looking at a lot of the the consumer durable stocks. Upasna.
Well, lower GST rate proposed by the government is expected to spur the demand for consumer durables, especially for categories like ACs and televisions. Now, analysts believe that this rate cut can mainly lead to a positive impact on AC stocks, which is why they can expect nearly 7 to 10% of price cut in the ACs, which is a key positive, which is why the stocks are surging in trade today likely. Now, if we look at the current tax rate, currently within electronics, ACs and large screen TVs, that is above 32 inches, are at 28% GST slab. while other categories such as smartphones, washing machines, refrigerators, microwave, geysers are at 18% GST slab. Now, looking at the brokerages, Jefferies says that the GST rate rationalization is expected around Q4 CY25, and it sees a good chance that the GST on ACs may go down to 18% versus currently 28%. CLSA says that it expects this change to strongly influence the demand for air conditioners, particularly after the recent sign of weakness seen in all these stocks in Q1 FY26. It also believes that this will affect sectors both demand, growth as well as profitability altogether. Kotak believes that the new rates may provide 2.4 trillion boost, benefiting mostly autos and consumer durable sector as a whole. Now, according to the media reports, Harrier Appliances says that any rate rationalization may give significant boost to demand when especially when AC prices are poised to go up next year due to energy rating. And lastly, Blue Star also says that while AC will compete strongly with other categories, it sees a big positive for sales this year time around.
Okay, all right, got that, Upasana. Thanks very much. And indeed, 7% to 8, 9% on many of these consumer durable names, AC makers especially. Well, with that, let's move on. Actually, we've spoken about a lot of the GST impact playing out. Let's also go back to some late earnings that came through and the outlook ahead for some infrastructure companies. IRB Infra is on our radar. In the first quarter, the company saw high single-digit growth in toll collections, while the order inflow was a bit muted. To talk about this and the trends ahead, let's discuss it with Anil Yadav, Director in Investor Relations at IRB Infrastructure. Anil, thanks for joining in. Let's start by the trends that you're seeing in toll collections, high single digits in Q1, whether you expect a pickup and what your outlook is on toll collections for the full year.
Yeah, thank you. Thanks for having me here. With respect to toll collection, we have seen a robust growth for at least for the first quarter, in spite of the June where the monsoon has started a bit early, but there was a healthy growth. And if you look at the July, we have already reported the number that was double digit, 10% growth was across the portfolio. And we are about to start with Ganga project in the second half of the year that will further boost the overall toll collection for the company. So considering the projects, Ganga will be also becoming operational. I expect double-digit kind of growth in the coming months for the overall company.
All right. Hi, Mr. Yadav. Good morning and good to see you in. So toll collection of double-digit is what you're working with. You want to throw some more color? Could it be mid-teens?
I think as of now, we are guiding only double digit because if you look at the first quarter, it was around 8% and we are expecting around 10 to 12% kind of growth in the toll collection on backdrop of the healthy collection what we have seen in the month of the July. And Palchet Dhankuni has also become fully operational in the month of July, and Ganga will become in the second half of this financial year.
Got it. On the construction vertical, earlier I think you were anticipating close to 4,000 crores of revenue. Is that on track? Could you outbeat that? I think for the first quarter you've done around 1,200 crores.
So I think as you are aware that this space will have an impact on because of this in the second quarter because of the monsoon. So typically as of now, we are holding our guidance of around 4,000 crores kind of revenue for the construction segment.
Okay, all right. What about order inflows, sir? Quarter one was a little bit soft. What kind of order inflows are you penciling in for the remainder of this year and for the year on the whole?
Yeah, so if you look at the IRB, we are having roughly 30,000 crores kind of order book. And gradually our O&M order book is consistently increasing, which is 10 to 15 years kind of order, which provides 10 to 15 years kind of order visibility. And in terms of the new addition of the order book, we are transferring the three assets from the private InvIT to the public InvIT, where the private InvIT is expecting to realize roughly 5,000 crores kind of revenue with a 5,000 crores kind of cash flow, which will be coming to the private InvIT. They can bid for that. Typically these projects are funded 70-30 debt equity. We can bag around 15,000 crores kind of project with that kind of liquidity coming in. And in terms of award, we have seen a muted kind of award till August. We expect that second half may be better in terms of the award.
Anil, this FASTag annual pass that's now active. I think it went into effect from the 15th of August. According to some estimates, and I'm looking at a CRISIL report here, it says that it could have a revenue impact of 4 to 8% on toll operators' income. What is your own assessment on how much it eats into your revenue?
I think one has to look at the concession agreement, and typically the model concession, which prescribes that if there are any changes post the award of the concession, that will fall under change in law, and whatever the losses will be there, that will get compensated under the change in law mechanism, and they will make the concessionaire revenue neutral. So considering that the government has already issued the notification stating that this will fall under change in law, for us it will be a revenue neutral. We will not have any kind of loss because of the implementation of the annual pass.
Okay, all right. So no impact for you. Got that. Can you give us a sense of the overall bid pipeline for you? The opportunities you may be considering via the PPP route going forward? Just break this up. I mean, BOT, really, what will your bid pipeline look like over the course of the rest of this year?
I think in terms of, we'll start with the monetization program, which was scripted in the budget. There was the total monetization for the infra sector was around 10 trillion. Out of that, 3 trillion was allocated for the road sector. So then that was the 4 to 5 years timeline. So roughly 60 to 70,000 crores kind of monetization one can expect on a per annum basis. We have not seen any kind of monetization happening till date. We expect that their project may be coming in the second half of the year. And there is around 45,000 crores of BOT also there, which is up for bidding. So as and when those opportunities will unfold, we will be bidding for the same.
Okay, all right, Mr. Yadav, appreciate you joining in. Thanks a lot for giving us your take on how the last quarter panned out and the way ahead. By the way, the Nifty is on its way to 25,000. We just kissed that mark a few minutes ago, and the Nifty Bank is participating as well. So it's green on the screen, things looking very, very good. The Nifty is firing, auto index is firing, and the big boy, the Nifty Bank as well, is just moved to around the 20-day MA. So let's slip into a short break. On the other side, we have the management of Vinati Organics that's waiting to detail their past quarter's numbers. Stay tuned. Well, as promised, let's discuss the quarter one performance of Vinati Organics. We have with us Vinati Saraf Mutreja, the Managing Director of Vinati Organics, who joins us on the show. Hi, Vinati. Good morning. Good to see you in as always. Well, before you get to your numbers, just wanted to understand what is your exposure to the United States? Exports are roughly around 55% of the mix. But to the United States, what is it at? And this recent Trump's tariff tantrum, so to call it, it'll have some impact on your business, I'm guessing?
Okay, good morning. Thanks for having me. So out of the 55% exports of our total company, about 33% out of the 55 is to the United States, of which the bulk of it, 80%, is ATBS and related products. So roughly you can say 25% of my revenue, which is exported to the United States, ATBS and related products, which are under exemption from any sort of tariffs. This has been since the case since the beginning of the year. So as such, the impact of tariffs is very little. Coming back to the remaining 5 to 6% of my sales, which is to the United States, there is no manufacturing in the US for those products. And hence, in most cases, either the customer is absorbing the tariff or they're lobbying with their government to remove the tariff. Thirdly, 2 to 3% of my revenue, which is some of the butyl phenols and the AOs, which are under the tariffs. We are still competitive, and if not sell to the United States, we have many other markets, including India, where we can sell that too. So net, there's almost zero to no effect of tariffs on my company sales.
Thanks for explaining that to us, Vinati. So you're sounding very, very confident, and you're saying that you're giving us the breakup and not much impact to your business. Take that on board. Let's get back to the numbers then. What led to the margin expansion in this first quarter? And is this sort of a margin performance sustainable? What's the outlook for FY26? We normally ask you for two numbers, margin outlook as well as revenue growth.
Sure. See, the margin expansion, and I've always maintained it's because the raw material prices came down in Q1 vis-a-vis Q4, and hence you saw that slight increase in EBITDA margin from 26% to 30%. Since we have a quarterly lag in our pricing, I still maintain on average on a year-on-year basis, 27% of EBITDA margin is what is sustainable for our product mix. Given that this year revenue growth, I do expect 15% revenue growth. Again, volume growth may be 20%, but because the raw material prices are falling and are fluctuating, hence I'm predicting a revenue growth of 15%.
15%. Okay. Vinati, hi. Morning. Just wanted you to address the news which came out yesterday. The anti-dumping duty which Commerce Ministry said DGTR is recommended anti-dumping duty on PVC. Now, upstream, downstream, is there any implication anything at all, Vinati, for you as a company?
I mean, look, if if PVC imports come down and more domestic PVC is going to be used, then of course the demand for my antioxidants increases in India, which anyways has been increasing steadily over the last 4-5 years, and hence we are very positive and bullish on the demand outlook of domestic consumption of AOs in India, because that is primarily it goes into plastics.
Is there enough? I mean, I think Reliance was setting up a PVC capacity. Adani's were setting up capacities, large capacities. I mean, will this? I mean, in terms of pricing for your products, etc., is there any lift at all because of this?
Well, for pricing on my products, because in my products I still compete with China and Singapore. So as such, it is a competitive industry, but the demand is increasing. We are backward integrated. We make our own raw material. We have reached break even in AO. And as the volumes pick up, we will soon see profitability there.
Another aspect, Vinati, again, this is slightly global in nature. In China, I mean, I spoke to this JP Morgan analyst end of last week, who said that across a range of chemical industries, especially polluting industries, China is once again curbing supply. For various measures, buying out capacity, 20-year plus capacities shut down, etc., etc. Have you? I mean, they're calling it anti-involution. I mean, basically preventing a race to the bottom across a range of these things. And one of the sectors most talked about is chemicals. Anything you can tell us, Vinati?
See, I mean, look, if it is a polluting process and that is why Chinese industries are shutting it down, then most likely we are not in those chemicals. We are into very specialty niche chemicals with green processes. So hence, this may not affect us directly, what you are saying, that shutting down of polluting chemicals, that will not affect my business.
Vinati, hi, morning. So coming to your capacity expansion, and there's a large expansion at play, right? I think your ATBS capacity will eventually go up by 50%. So where are you in terms of the commissioning timelines of all this? And then what visibility do you have in terms of the utilization of this new capex and overall revenue growth, say, over the next 2 years? Vinati? Okay.
Can you hear me?
Yeah, we can hear you now. Yeah, the question on your revenue growth and the utilization of your expanded capacity, because it's such a huge amount of capacity that you're putting on stream now.
Sure. So the ATBS capacity expansion is happening in 2 phases. The first phase of 10,000 tons, it's actually completed now in August. We need to take a shutdown to integrate that plant. And since we are oversold on ATBS, it is taking a bit longer. That plant pretty much in the new line over the next 6 months. The second line, the other 10,000 tons will come in at some point next year around April 26.
All right, Vinati, we leave it there. Thank you very much for joining us. Good speaking with you, and indeed, thank you for that outlook. Nikhil Gupta is now joining us. He's India economist at CLSA. Nikhil, good morning. Great to have you with us here. Thank you very much. I think we're speaking for the first time since, in the new avatar, if it's at CLSA. So good to have you on board. And I hope this is the first of many interactions here. Just Nikhil, how are you thinking about you're somebody who's for years, talked about how demand has been a problem, across, and consumption has been a real problem. We've had those around the budget every year, we've had interactions, etc. Will the GST rationalization in a durable way lift mass consumption? Actually, forget mass consumption, consumption broadly across sectors. How do you think about this, Nikhil?
Thank you, Prashant. Good morning. Thank you for having me on the show, and it's nice to connect with you always. Okay, so yes, Prashant, broadly, we have always believed that household finances have been really weak in India, which is going to hurt consumption, and we are seeing consumption growth. We are seeing consumer companies struggling to post volume growth. And if you look at what the government is trying to achieve over the past 2025 year at least, they started the year in the budget. They announced an increase in the income tax exemption limit, a significant increase, which was supposed to give a boost to consumption. Then we saw a decline in interest rates from the RBI, and now Prime Minister Modi has announced that by Diwali we will see some GST rationalization. So one thing is very clear, that there is an acknowledgement of consumption slowdown, and the government is trying to address it through various ways. Now, the question is, will GST rationalization help to reverse this slowdown in consumption? It's too early to say at this point in time. We do not know the details. If I just go by the headlines, and if I do a rough calculation wherein we assume that 12% and 28% GST slabs are gone and they respectively move into 5% and 18%, then the calculation suggests that the total loss to the government on an annual basis could be in excess of 1.5 lakh crore, 1.5 trillion rupees, which at this point in time seems too high to believe. We know that the direct taxes has not been very strong, especially personal income taxes. We are going to see the impact of the increase in exemption limit. At the same time, we know that the government is very serious about their fiscal deficit number. So we don't think that fiscal deficit number would be something that would be compromised. Even if there is a shortfall in receipts, it is very likely to be adjusted through lower spending rather than adjusting fiscal deficit. So all in all, broadly, as I said, there is clear acknowledgement that consumption slowdown is there, and the government is trying to address it through various ways. But we must understand that this slowdown in private final consumption expenditure or household spending in general has been playing out for almost a decade now.
Just one thing, you're just sheer numbers. You're saying 1.5. They can't find. If you go by media reports, it basically a little over 1.5 lakh crores. You're saying that can't be found. That money can't be found elsewhere by doing, increasing something. We don't know how, but you don't think there is any room given the state of finances?
No, I'm saying if this is a gross losses, I'm saying the government cannot afford to have these kind of losses at this point in time, because we are already seeing shortfall in the direct taxes. So it is very likely, if we see these kind of losses to the tune of 1.5 or excess or thereabout, the government will try to make up at least a part of that through some other ways. Now, we don't know what those other ways would be. All we are doing right now is speculating on the statements made by Prime Minister Modi on the Independence Day speech.
And Nikhil, just to clarify, the 1.5 lakh crore rupees of loss that you're talking about, that is total loss, states plus centre, or that is just the centre's component?
That's the combined losses.
Yeah. So, would you sort of bifurcate that and give a sense of the centre's share, and then therefore we have to see how much they're foregoing through direct taxes because of the income tax cut, and then through the indirect tax route? How much would be the centre's hit?
No, again, because we do not have the specifics of this GST rationalization, it is very difficult to put in a number. But broadly speaking, we can say it would be 50-50 between centre and states combined. And we also need to remember that all the decisions related to GST rates are taken by the GST Council. So states also have the equal say, if not more, in making changes to GST rates. So
the other thing is to take your point. So 50-50, roughly speaking, centre's hit would be about 75,000 crores and similar for states. The other thing which our colleagues are reporting is that in the new avatar, the compensation cess needs to go. So that little cushion also is not available anymore. So will the set-off really play out? The government's hope is that overall increase in demand will lead to tax buoyancy and they'll make good most of the 75,000 crores. Do you think that could be a realistic scenario?
I would not go by the assumption that whatever the makeup by higher demand would be more than 75,000 crores. That, according to me, would not be my base case at this point in time. But again, I'm repeating again and again, we do not know exact details. We do not know which items would be affected, which segments would be affected, how much price elasticity would be there, what would be the increase in demand. So it's very difficult to answer these questions at this point.
Yeah. Nikhil, just since we are talking in hypotheticals, and maybe we'll have you, would love to have you back on later this week when the GOM, etc. is done. You said they'll have to make up this revenue loss through some measures, right? Since we are talking in hypotheticals, what could those measures be?
I would not go into those kind of speculation at this point in time.
No, but broadly, with what you're thinking and how the government is sort of behaved on other taxation, etc., what could it be? Where would they go? Which areas would they go to make up for this, in your opinion?
Very difficult, because first of all, we need to be very clear that 1.5 lakh crore, what I'm saying, this is a very gross number based on very rough calculations. We do not know exactly what would be the losses, what would be the rationalization look like eventually. And you talked about compensation cess. We know that compensation cess is going to expire in March 2026. Now, again, we do not know if it is going to end in March 26 before that, or if it will be extended, because the decision on that is also pending. So a lot of questions are there. It is very difficult, even speaking hypothetically, to answer your question at this stage.
Okay, all right. Hi, Nikhil. Good to see you again. We have discussed a fair bit about the GST cuts. I wanted a couple of numbers. One is with regard to the tariffs that are imposed on India by the United States. What would that be? What impact would it have on our GDP if you could quantify it? Point number one. Point number two is, the RBI has done its share with regard to monetary easing. Do you think we have another rate cut in store in the coming months?
Hi, Nigel. Good morning. Okay, to answer your first question, our calculation suggests that the tariff impact could be as much as 60 bips of GDP growth, again on an annual basis, which means that if the new tariff of 50% comes into play and remains so from the end of this month, then FY26 growth could be impacted by as much as 35 bips. Now, again, this is the maximum impact that we're talking about. There are, again, a lot of ifs and buts. We need to see what kind of changes do our producers or exporters do in terms of finding new markets, how soon they can find it, how soon will the US consumers be able to adjust with some things where India holds some bargaining power in terms of diamond jewelries, etc. There will definitely be some sectors where we'll be hit, and that's why there is no denying that if these new tariff rates remain in place from this month end, we will have an adverse impact on GDP growth. But the total impact, according to us, would not be more than 60 bips on an annual basis.
And RBI, yeah.
To answer your second question, RBI, again, we have always held since the June 50 bips rate cut by the RBI. We believe that GDP growth forecasts of the RBI in general are still optimistic at this point in time. There is a high probability that GDP growth, actual GDP growth would be on the downside, and inflation would also be lower than what the forecast, even the new revised forecast, we are saying there is a possibility that headline inflation, because of food and vegetables in prices, would be lower than what the forecasts are. And if that is the case, we believe that there could be a rate cut, very likely in December. We are still not putting October as our base case, because we must remember that the CRR cut that the governor announced in June, kind of pre-announced, have still not taken into place. So they will start from October and they will continue till November end for 2 months. Sorry, they will start from, right? So once that happens, we believe if the next rate cut has to happen, it will happen only in December, the first week of December, when we have the next policy. That is what our base case is right.
So December rate cut. Got it. Nikhil, just quick last point on GST again. And we hate to tie you guys up in numbers. But like you gave us that number for tariffs. Tariff impact is roughly 35 basis points of GDP. Now, this GST cut, if it materializes in the current form that is being discussed, is there any estimation? Could it boost GDP growth by, I don't know, 30 bips, 40, 50 bips, or maybe credit offtake by any certain measure? Any such formula that you've been able to work out?
Not done right till now. So because, see, the impact will be huge. First of all, we need to be very clear about what kind of government losses will be there in terms of the receipts. Then if the government makes some other adjustments in order to make up for those losses, we know once we know the items which are moved into what, then we would have to have some impact on inflation as well, which definitely would give some boost to consumption. And that is when we'll be able to do some calculations on consumption and GDP growth. At this stage, I'm sorry, I do not have any specific answer to give you on this.
Okay, always cautious and, held back with, and that's the way to go, right? I mean, instead of jumping and putting out specific numbers when we don't know. Thank you very much, Nikhil. As I said, hope this is the first of many. Appreciate your time here on CNBC-TV18. So that's Nikhil of CLSA with perspective on the GST announcements. Let's get you some insights from Mahindra and Mahindra. My colleague Shivani spoke with Rajesh Jejurikar of the impact of rare earths crisis. Listen in to what he had to say.
Yeah, Shivani, we spoke about this a couple of weeks back after our earnings call, and we said at that time, and I have no new update, that we are covered for Q2 and Q3. We have a couple of components, a few components to address in Q4, and we have a reasonable path. And we put in multiple mitigation actions, which I wouldn't go into detail of.
Okay, and Mr. Jejurikar also reacted to Prime Minister Modi's announcements of GST reforms coming up around Diwali. Take a look.
You know, the thing about gifts is you should accept it with grace.
Absolutely.
And let it be a nice, pleasant surprise.
Yeah.
But I would just add to say that, automotive is a very key sector in India. It's a GDP multiplier. It's an employment multiplier. And with the kind of technologies we are developing in India, there's a huge opportunity for Make in India for the world. And a key part of Make in India for the world is about how much you can sell in your own home country. The more you sell in your own home country, the stronger you become. You start getting economies of scale, which allows you to be more competitive. The supply ecosystem builds up. And like I said, it's a huge employment generation as well.
Okay, well, those are some comments coming in from Rajesh Jejurikar of Mahindra and Mahindra Group. We'll take a quick break here. Manisha focuses on commodities on the other side. Stay tuned.
Welcome back. By the way, I hope all the Mumbaikars out there are staying safe. Our colleague Santya has just told us that the warning for Mumbai has now been elevated to red. It was orange up till now, but now it's a red alert, I think up till 12 o'clock. That's what the latest is. We'll put out those comments in just a bit. But we have Manisha joining in with the latest from the commodity markets. Manisha, what's hot?
The crude is really because, and not because it's boiling hot, but because it's continued to extend declines on the lower side. Well, last 2 weeks actually have seen declines in crude oil prices. And with that, we're down by 10% for the month of August. We are down 13% for 2025 till time. And we are also trading at 2-month lows in the international markets there, with 62 for WTI and 65 for the Brent crude oil prices. So it has been a sharp decline over the last couple of weeks there. Well, interestingly, it is the higher supplies in the global markets. The U.S. production is near record highs. The U.S. inventories have been rising as well. OPEC has increased production until the month of September. So you are looking at enough and more supplies there. Apart from that, it really is about the U.S. and Russia meeting, which has failed to get us a ceasefire. But a peace deal is what markets really seem to be talking about right now. And Russia, in the meanwhile, has asked for Ukraine territories. More conversation on that is expected today as the U.S. president will meet presidents and head of states from NATO, France, European Council as well, and then Ukraine, France, etc. So that meeting is something that the street will keep an eye on. Just to take a step back and give you through the timeline, really, when it comes to the Russia Russia and Ukraine conversations there, we already have had the US, UK, European Union prohibit import of seaborne crude oil in the first year of Russia-Ukraine war itself. And that is the reason much of this crude started to flow into Asian countries like China, Turkey, India, etc. So much so that India was buying 40% of its crude oil from Russia in the last couple of years. Adding to that, you also have the G7 countries imposing price cap on Russian oil at $60 in December in 2022. They have tried to revise it much lower to almost around $47 a barrel as well, but there is no backing from US and we haven't seen that implemented because of that. The other thing really is about sanctions, not just on the crude, but also on Russian companies, individuals, insurance, fleets, etc. There also are secondary sanctions in place, especially with India bearing the brunt of it, where 25% additional would come in from 27th of August if more negotiations do not go through. Interestingly, when you look at the Chinese data, all of that has come in on the weaker side for the month of July. That seems to be weighing onto the crude oil prices as well. So whether it is about July industrial production, the retail sales data, the new home prices, it is lower on a month-on-month basis. It is also lower on an estimated basis as well, and lower as compared to previous year also. So that doesn't augur well for many of these commodities, which actually have started Asia on a weaker note today. And when you talk about the outlook, well, that seems bearish as well, because most of these banks and brokerages are talking about lower crude oil prices. 60 to 66, as you can see on your screen. Goldman Sachs also has revised its 3-month target for the crude oil prices. It does believe that 66 of an average is what you could see. But apart from that, it really is about 60, 62, 65 is where we could be looking at the crude oil prices going forward. There's HSBC talking about 68, 60 from USIA, and ETO market says that sub-60 kind of levels also could be seen. If there is some patchwork done, if there are some resolutions coming in, things are sorted, you could be looking at sub-$60 as well by the time we end this year.
All right. Manisha, thank you very much for that. That's commodities in focus there. We take a break. Special Indianomics segment coming up with Lata talking about the impact of the S&P upgrade, tariff hike, GST cut on the economy and bonds. And she'll be joined by Neeraj Gambhir of Axis Bank, Sonal Verma of Namura, Kanika Parishya of Union Bank, and Sameer Narang of ICICI Bank's Power Pack lineup on the other side.